Quick reminder, the price for all of my courses linked down below will be going up in 2 days. That means the coupon code is expiring and prices will be going up in 2 days. That is June 30th. Take a peek at the links down below. Hey everyone, me Kevin here. Goldman Sachs thinks the market could roll over and they give 3 scenarios. They start with number 1. What if inflation is not transitory? This is obviously hotly debated. Half of us in my audience tend to believe that inflation is here to stay, and the other half of us tend to believe that inflation is transitory. It's kind of as bad as picking a side in terms of Democrat or Republican. Like, you either believe it or you don't, and you're on the totally opposite side of the spectrum, usually. It's pretty incredible. It's like a new label. You're an inflationist or you're not. All right, folks. What they mention here is that if inflation is not transitory, the big danger will be defending profit margins. Folks, there are plenty of companies right now that are working to defend their profit margins, specifically because of inflation being here now. We know that inflation is here now. There's no doubting inflation is here now. Prices have gone up. It has become more expensive to ship. There are companies slowing down the innovation process because of a lack of microchips with supply chain issues. Enphase is a perfect example of this, which I think is artificially putting a lid on the growth of a company like Enphase, which could create for outsized returns in the future. But anyway, you've got an incredible increase of prices that we've seen recently, not just in assets, but in commodities and individual goods, although commodities are recently rolling over as well. Lumber's plummeting, which kind of expected that commodities would roll over. But anyway, let's focus on this. If we get inflation to inflect downwards, hey, great. Now that pressure on companies' margins or their bottom line goes away, and we're good. If inflation keeps going up, prices are going to have to go up, and that's going to lead people to spend less on products, on goods and services, potentially at the same time as leading to less profit from companies. Now, in the short term, higher inflation expectations could lead people to spend more to try to avoid those long-term inflationary aspects, which just compound short-term supply chain issues. It's a disaster, basically. So, bottom line here is if inflation is not transitory, you probably don't want to invest in companies that are going to suffer from supply chain issues or their margins going down. And Goldman Sachs believes the best companies to invest in or industries to invest in are industries like healthcare, energy, real estate, and consumer staples, because they believe that these outperform in an inflationary environment. They say that these are industries with pricing power. Now, the second thing is, and this is where they also give us an idea as to how much they actually think the market might roll over, Goldman Sachs forecasts that the 10-year treasury will go up to 1.9% by the end of the year. It's currently sitting around 1.5%, and it's been trending down. That downward trend is actually very, very important, because the more it trends down, the less we actually think we're going to see rates go up faster to combat higher inflation. And again, the trend has been down. Let's look at the trend year to date to get a visual of this, and that would be right here. There we go. This is the year-to-date visualization for 10-year treasuries, and you could see we've got a solid downtrend here from peaks of around 1.7, 1.72, down to about 1.48 now. We've actually fallen as low as 1.45 recently, 1.38. Very briefly we fell, but during this period of time right here, where the 10 years went up, all you have to do is overlay any kind of tech stocks starting around February 19th when the market started realizing, oh my gosh, treasuries are going up, and you basically see tech stocks go down as fast as 10-year treasuries went up. So yeah, you want to pay attention to this, but right now, the trend is not in favor of tech selling off. The 10-year trend is actually in favor of tech and in favor of lower rates and in favor of less inflation coming than expected in the future months. Some sort of inflection point to the downside expected, which is good. But then, going back to Goldman here, Goldman mentions, what if interest rates fall or rise more than expected? And the answer here is, they believe that if rates are to overshoot Goldman's forecast of 1.9 and finish the year at 2.5, they believe the S&P 500 could potentially drop 17%. In my opinion, this leads to the potential for November and December pain in the market. And the S&P 500 rolling over in this kind of scenario, in my opinion, has approximately a 10% chance. Totally my opinion. It is not something you want to trade off, and if you lose money, it's your fault. Don't sue me, bro. I am a dude sitting here with a green rubber straw in his coffee mug and a RuneScape fire logo on it, and also running for governor in California. So take it for what it's worth. Okay, now, they do mention, well, obviously the inverse would be true here, is if we do not see the 10-year inflect up to 2.5% by the end of the year, then we would expect potentially the S&P to continue to roll on. Now, there is a middle ground here where the S&P potentially stays flat. Now, why would the S&P 500 stay flat? In my opinion, it could stay flat if tech stocks and consumer discretionaries rotate up. So you get tech and consumer discretionary rotate up, but at the same time, you end up getting recovery stocks rotating down, which recovery stocks have been the big reason the S&P 500 has been going up the beginning half of the year. It's not just recoveries though, it's industrials, right? It's okay, some of the consumer cyclicals, real estate related stocks. These stocks, with the exception of the tech ones like Zillow and Redfin, these companies have been doing very, very well, and they've been offsetting that tech decline. But if you get that rotation back and you get more of a sell-off and recovery, it's possible you could have either a slow growth or no growth S&P 500 for the year, and tech ends up doing very well. So probably the safest place to be is just in the middle, which is S&P 500 index fund. If you want to take a side, if you believe inflation is coming, you probably want to be in those consumer cyclicals, the real estate, the healthcare, right? If you don't believe it's coming and you think the 10-year treasury will end below 2.5 at the end of this year, you probably want to be in tech. And I personally think tech is here for at least the next 4 months. Now, I am going to be cautious about this potential for November, December pain, because I think this is when we're going to start pricing in Q1 and Q2 of 2022 earnings. Q1 and Q2 earnings in 2022 are going to be really interesting because they're going to do year-over-year comparisons to 2021. And the reason that's going to be a problem comparing 2022 to 2021 is I expect 2021 numbers to have created such massive profits and such massive growth, especially for tech companies, that's going to be really hard to beat those numbers in 2022. I think the numbers might beat slightly or possibly even rotate down. So we could see some shrinkage in companies, especially tech companies, in the first half of next year, which in my opinion means you probably, if you've got options on tech, you probably want to take advantage of a rally sometime between now and 3 months from now. Get out of your options, get into shares, and then ride the roller coaster. Some thoughts. Okay, now another one. Scenario number 3. What if tax reform doesn't pass? Well, we know that Joe Biden has proposals to increase the not only a capital gains tax on individuals making more than $1 million a year, but also increasing the top rate to 39.6% for those millionaires. That would also apply to dividends. And there's also talk about a corporate tax gains hike from 21% to 25%. So far, we don't know if Biden's actually going to be able to get this in. Now, if Biden gets the soft infrastructure plan in with tax hikes solely using Democrats, which a lot of folks believe they're going to use budget reconciliation, they're going to squeeze this through, they're going to get some tax hikes through, then yeah, we might see some neutral pressure on the stock market, because I think a lot of the tax hikes that were proposed by Joe Biden are already priced in, because Joe Biden has made these plans very, very clear over the last few months, starting especially in January, February, and that's kind of helped lead the stock market to push down on tech and high growth stocks. However, if for some reason these tax plans do not end up going through, they just don't end up getting the votes, they don't get the full 50 votes with Democrats, somebody like Joe Manchin or Kyrsten Sinema say, you know what, I don't want these tax changes, then Goldman Sachs, and this is an interesting estimate, Goldman Sachs believes that if we don't end up having the tax reform, we could end up seeing stocks, or the S&P 500 that is, bump up by 5%. Which is kind of cool to see them value the tax reform at about 5% on the S&P 500. So pay specific attention to the likelihood of Joe Manchin or Kyrsten Sinema voting for a soft or social infrastructure package. And that's very, very important because, well, clearly here we know that if we don't get tax increases, we would expect to see some kind of bump in tech, specifically tech as well, because tech tends to have larger gains, and as a result, you tend to have higher gains baked into people's portfolios, which means at the end of the year, you could end up seeing December pain if tax rates do go up, because people might want to dump and realize some of their gains this year, because selling this year would almost create a little bit of a tax coupon for them, because you'd be selling stocks at a lower tax rate. So what we got here is the three things consolidated. What if inflation is not transitory? Well, if inflation is not transitory, guess when we're gonna know that inflation is not transitory? By November to December. I personally think we're going to see the inflection point in September and October. That's where we're going to see the inflection point. China's already seeing the inflection point downwards. Bank of England's already seeing the inflection point downwards. We expect the inflection point to come. If it doesn't come by November, December, it's going to be a problem. What if interest rates go up more than expected and we end up overshooting the 10-year at the end of the year? November, December pain. What if tax reform ends up going through and we don't get the support? Boom, we end up getting December pain as people dump. So you could potentially set up for a rollover towards the end of the year based on these three particular items to watch in the market. So as always, subscribe to this channel so I can keep you updated on exactly what's happening with these three different things. You know, I pretty much give you daily updates on the market, so if you haven't subscribed yet and you like this kind of content, make sure to hit subscribe on this video because it's going to let me know that you're interested in this kind of content. Thanks so much for watching, and we'll see you in the next one.